Growth versus value investing. IWF versus IWD. What's the difference and which one is better? That's what we're going to cover today. By the way, everything in this video is education, not advice. I was recently asked to do a video on IWF, the iShares Russell 1000 Growth ETF. No one has asked me to do a video on IWD, the iShares Russell 1000 Value ETF. You know why? Because growth has crushed value and IWF has crushed IWD lately. Like basically for the entire time most Gen Z and millennials have been investing. So does that mean growth investing is better than value investing? The short answer is no. Would you believe that value investing has historically done better? It's true, according to this chart from DFA, Dimensional Fund Advisors. If growth investing is inherently better than value investing, then why do you think the greatest investor of all time, Warren Buffett, was a value investor? The reality is that neither approach is inherently better than the other, and they tend to go through long cycles where one is in favor over the other. If we go back to the inception of IWF and IWD in 2000, you can see that their returns are almost identical. Growth crushed value in the 90s during the tech bubble, which was just bursting when these ETFs were created. Then growth stocks actually fell from early 2000 and didn't recover for over a decade. Value dominated. But then ultra low interest rates and technological advancements like cloud computing, social media, and e-commerce led to a resurgence in growth companies. Will AI continue that trend, or could we be in another overhyped bubble like the internet in the 90s? If you've got a strong opinion on that, this video will help you decide what to invest in. I'm going to start by explaining the difference between growth and value investing. And then I'll cover some of the misconceptions about each of them, why growth has done so much better lately, how IWF and IWD pick growth and value stocks, and I'll end with a few ways you can incorporate value and growth into your portfolio. The first thing you need to know about growth and value investing is that they're not opposites. As an investor, you want to find stocks that will go up in value and make you money. Growth and value investing just focus on different ways to do that. There are 3 ways that stocks can make you money. The first is that the company can grow its earnings. When you buy a stock, you're a part owner of that company. When that company makes more money, it becomes more valuable over time. This is the main area of focus for growth investors. They look for the companies that are going to grow their earnings over time faster than others. The second way stocks can make you money is by going up in value. The simplest way to understand this is through the most common valuation metric, the PE ratio. The PE ratio means the P, price, that investors are willing to pay for each dollar of E, earnings. Growth investors focus on earnings growing faster. So if investors pay the same price for each dollar of earnings and the earnings double, the stock price will double. Value investors focus more on the P, the price. They look for stocks that are too cheap for the earnings the company is generating. They're looking for bargains, for deals, where they think the price or valuation will go back to a fair value. If a stock keeps the same level of earnings, or E, but the price people pay for those earnings doubles, the stock price will double. The third way stocks can make you money is through dividends. Both growth and value stocks can pay dividends, but they're more common in value stocks because companies pay dividends out of their earnings. Companies with more growth opportunities will often want to reinvest all their money into growing their business rather than paying dividends. More established companies with less growth potential are more likely to have money left over to pay dividends. This brings us to the first key misconception about growth and value, that they're polar opposites and the other one is stupid. If value investing is just finding cheap companies, then does that mean that growth investing is just buying expensive companies? No. Why would you want to do that? On the other hand, if growth investing is just buying fast-growing companies, then does that mean that value investing is just buying slow-growing companies? Also, no. There are almost an endless number of ways to group companies together based on different characteristics. Like, imagine you wanted to group people together based on whether they were big or small. Would you use height, weight, muscle tone? And what if someone was really tall, but also really skinny? Companies are like people. They're all different, they're all unique, and just like with big or small people, not everyone agrees on how to classify companies as growth or value. Let's take the Russell 1000 growth and value as an example. These are the indexes that IWF and IWD track. Russell gives each company in their universe a score to determine how growth-oriented or value-oriented they are. On the growth side, the score is based on 2 things: the average projected earnings growth for each company over the next 2 years, and the historical sales per share growth over the last 5 years. On the value side, the score is based on the price to book ratio, which is another valuation metric similar to the PE ratio that we covered earlier. This brings up a whole host of questions. Why 2-year earnings growth instead of 1 year or 3 year? Why use PB instead of PE ratio? There are a million combinations you could use, and if you look at other providers like Morningstar or S&P, they all differ a little bit. Then what if a company is cheaper than average based on PB, so it should be in value, but it's also growing faster than average, so it should be in growth? Just like the size of people, it's a spectrum. These factors determine how value or growth oriented a company is. If a company has both value and growth characteristics, it can be included in both indexes. About 30% of the companies in the Russell 1000 are included in both the value and growth indexes, including Coca-Cola, McDonald's, and Nike. Companies can also move around over time. For example, in June 2022, a lot of traditional growth stocks like Netflix, PayPal, and Meta were added to the value index after their share prices fell due to rising rates. That brings us to another common misconception. Value stocks are not always boring, steady-eddy companies, and growth stocks are not always high-flying tech startups. Those are oversimplifications, and they're not always true. My next two videos will break down value and growth investing at a deeper level, but for now, within value, there are deep value companies that are nearly bankrupt and offer a high risk reward, beaten up growth companies that have fallen out of favor like Netflix in 2022, and steady-eddy companies like Berkshire Hathaway. In growth, there certainly are some of those high flyers, but there are also companies like Coca-Cola that provide more steady growth over time. Since everyone's definitions of growth and value are different, and companies can switch between them over time or be in both at the same time, and both styles can go heavily in favor or out of favor for a long time, how the heck do you incorporate all of that into a portfolio? Well, there's no one universal right answer, but I'll give you 3 common ways people do it, and one may well be more right for you than the others. The first and most common for individual investors is to just take growth and value out of the equation by buying a fund that includes both. You can find these by looking for broad index funds that don't have a style on the end of their name like SPY or anything that tracks the S&P 500. IWB or anything that tracks the Russell 1000 or any of the Vanguard's index funds with the word total in them like VTI, the Vanguard Total Stock Market ETF, or VXUS, the Vanguard Total International Stock ETF. By the way, the NASDAQ does not count. It's very growth oriented. For any stock ETF or mutual fund you're considering, you can find this chart by going to Morningstar.com, typing the ticker symbol into the search bar at the upper left, and then clicking on Portfolio. Here you can see from the blue circle that VXUS is right in the middle. And you can see from the bigger blue oval that its portfolio includes lots of value and growth stocks, which are mostly large companies, but also have some mid-sized ones. The second way to incorporate value and growth into your portfolio is to separate them with investments that focus on each area individually, like IWF and IWD. There are 2 possible reasons to do this. 1, you think either growth or value is going to be in favor and you want to make an active decision to own more of it. Or 2, you want to invest with specialist investors who have strong track records of picking either growth or value stocks. For example, Steve Weimer has managed the Fidelity Growth Company Fund since 1997 and has absolutely crushed IWF in growth investing. The Dodge & Cox stock team specializes in value investing, and that fund has dominated IWD. There's no guarantee they'll keep doing that in the future, but you could combine a value and a growth fund that you have confidence in and try to do better than the overall index. Or you can find growth or value funds with different profiles like lower risk, higher dividends, more concentration in tech, or pretty much whatever you like to tailor them more to your personal investment objectives. The third way to incorporate value and growth into your portfolio is to invest in an active manager that has flexibility and does both. Like I showed you earlier, neither approach is always right or always wrong. One of my favorite international equity funds is MFS International Intrinsic Value. What's interesting about that fund is that it didn't used to be called that. It was called MFS International Value for a very long time, and they added the word intrinsic in there to symbolize that they weren't really just looking for cheap companies based on some arbitrary metric like an index would. They were looking for companies that they consider to be a good value based on their future earnings. For example, let's say you could buy a Kia for $20,000 or a Ferrari for $30,000. Is the Kia a better value just because it's cheaper? No. In this case, the Ferrari would be a better value. It's the same with companies. A company that can sustain its growth for a long time is more valuable than one that might not be able to. But that's not going to be reflected in a 2-year earnings growth projection. The greatest investors of all time have, for the most part, not boxed themselves into either growth or value. One of the greatest investors of all time, Peter Lynch of the Fidelity Magellan Fund, is thought of as a growth investor, but his approach was more like a combination of the two. His style was what has come to be known as growth at a reasonable price, or GARP. That's the idea that you want to buy companies that are growing, but you don't want to overpay for them. The most famous value investor of all time, Warren Buffett, also didn't just blindly buy the cheapest stocks. He said it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. When it comes down to it, these approaches really aren't that different. In my next videos, I'll be diving deeper into growth investing and value investing individually. How do you do it? What are the different types of growth and value investing? Who are some of the top growth and value investors of the past and present? And much more. If you want to continue to build wealth and become a better investor, hit that subscribe button so you don't miss those videos. And if you want to continue the investing conversation, check out the link below to my free Discord. If you don't know, a Discord is like a Facebook group. There, you can have direct access to me, but you can also talk with others that are watching my channel and trying to learn more about investing as well. Thanks for watching, and I'll see you in the next video.